Hello, everybody. Just got some technical difficulties. Hope you're all doing well.
Hello.
There you go.
Yeah,
Great.
we're fixed. Good afternoon, Seoul. My name is Nabil Kaber. I'm the founder of Forbit, the modular stablecoin protocol. And it's a real honor to be here at Korea Blockchain Week with all of you and with Haseeb, managing partner of Dragonfly Capital and one of the most respected voices in the space. Today, we're going to talk about one of the most interesting things going on, stablecoins. So Haseeb, welcome. Most of us here know you and know your work, but what's most interesting thing to you right now at Dragonfly?
So, crypto industry has been moving a lot over the last year. And at Dragonfly, we're just trying to keep a handle on all the ways in which the world is changing, especially with regard to stablecoins. So we've seen just this year, the passage of the Genius Act. We've seen Circle basically go public in one of the most blockbuster IPOs of the year. In addition to that, we've seen many other countries pass their own stablecoin bills. I know Korea currently has like 4 bills that are currently working its way through the Korean legislature. Add to that, you've got things like Ethena becoming the 3rd largest synthetic dollar in existence today, growing like crazy. You've also got things like USDH. You've got USAT, which is Tether's US-facing business. Everything is moving right now. You've got Tempo, Stripe. It's a lot to try to digest. And as an investor, our primary mandate is to figure out where is all of this going. So every day, I'm talking to issuers, I'm talking to businesses working with stablecoins, and trying to draw the line out so we can stay one step ahead of it.
Yeah, so I think, like you just mentioned, it's an ocean of choices, of issues that are facing the market, and maybe we can break them down. So some of the things you mentioned. What are your thoughts on regulated versus virtual stable tokens, or fully pegged versus synthetic dollars? Given your experience in the space, how would you start explaining the marketplace to all the folks that are trying to enter it?
So the vast majority of stablecoins today are fiat-backed stablecoins. These are the types of stablecoins that are regulated by the Genius Act and that require all the stuff that we've been talking about. So the largest are obviously Tether and Circle. We talk a lot about RWAs. Stablecoins are the original RWA, right? Stablecoins, it's a real-world asset in that there's real dollars in a real bank, and there are one-for-one tokens issued that correspond to those dollars. That's an RWA. Right? So that's what most stablecoins are that exist today. Then you have the crypto collateralized stablecoins. Those are the earliest versions of decentralized stablecoins like MakerDAO. You've also got Liquidity. There's some projects that still exist today that do this, but they've largely taken a backseat to what's increasingly called these synthetic dollars. And synthetic dollars are things like Ethena. So Ethena is not built the same way that something like MakerDAO is. It's built through basically a derivative. So the simple way to understand Ethena is like, it's like a tokenized cash and carry trade. So you go long the spot, you short the futures, and you collect the interest or the basis that you get paid for being entered into that position. That's Ethena. It's grown to be massive because of the fact that it has an uncorrelated source of yield. One of the key features of the Genius Act, which is the bill in the US, is that stablecoins are not allowed to directly pay yield to holders, okay? Now, why does this matter? This matters because all the stablecoins today cannot give you what they're getting. They're getting the Fed funds rate. They're getting 4% a year. They can't give that to you by law. That means that you hold a stablecoin, you're getting 0. So there's a lot more interest because of that in getting the interest. That's what Ethena gives you, but it gives you an uncorrelated source of yield. Even as the Fed funds rate goes down, the yield that you can get on something like Ethena goes up. So that's part of the reason why it's grown so much and why these things are so attractive today.
So I think, riffing off of that, from USDC to Tether to Ethena, as you mentioned, to Hyperliquid, how do you differentiate from the actual models of the business to the utility they provide to the users, to kind of how they operate, and how does that affect kind of the landscape of stables moving forward?
Yeah. So if you rewind the clock to 2018, 2019, people largely did not trust stablecoins by default, right? Most people in 2018 assumed that Tether was a fraud and that it was going to collapse. I remember when there were huge bets that people would make and trying to short Tether because they thought it was going to depeg and collapse. Nobody shorts Tether anymore. It's just a waste of your time.
Too big.
The same thing is true for emerging stablecoins. So if you look at things like TrueUSD, I remember way back in the day there used to be all this FUD that, oh, TrueUSD is depegged, like this is going to collapse too. People did not trust these things. And if you look, of course, at the early decentralized stablecoins, even things like that were competitors to MakerDAO, a lot of them broke, a lot of them failed. If you remember, Fei was a stablecoin that depegged and failed. Of course, the most famous of them is Terra, was a decentralized stablecoin that depegged and failed. Now, the models for all these are very different. But the one thing that you know for certain is that more stablecoins died than survived. Now look at today. Okay, today, you see a new stablecoin, by default, you assume that it's legit. It's one of these untold miracles of crypto that we've now entered into a regime that most people think most stablecoins are actually fine. And this is because we now have, Paxos as one of the biggest issuers issuing these white labeled stablecoins for which they have, New York trusts that custody the actual underlying assets. Same thing is true when you look at Stripe and Bridge. Bridge, they have their own stablecoin. It's fine. People assume that it's going to be stable and trustworthy. PayPal is a stablecoin issuer now via Paxos. So we're now in a regime today where people largely by default trust stablecoins as opposed to not trusting them. And that allows you to have these white label stablecoins like what Hyperliquid is doing with USDH. With USDH, they're not creating their own stablecoin from scratch. There are teams that are potentially doing this from scratch, like Native Markets is doing this from scratch, but they're using Bridge or Paxos or Agora or one of these other issuers underneath the hood who are all regulated, very stable, very high quality collateral, high quality backers, and that's the state of play today. So nobody's worried about stablecoins collapsing per se, but the race now is more about branding, distribution, and go-to-market.
So now that, as you said, so it's more mainstream. Stablecoins are already processing trillions of dollars, in the crypto markets. Do they evolve into a mainstream utilization? Do they become institutional? Do they become the norm of how everybody transacts globally, or are we far away from that?
So, when do stablecoins become normal? It's kind of a deep question. And I think in a way, in order to understand that question, you have to break down what do people actually use stablecoins for? We're in crypto, and so we're going to kind of tell this big story, oh, people are using it for everything. But that's not true. There are a few things that people really use stablecoins for. The first use case for stablecoins was always crypto trading. That was the first use case for stablecoins, right? And that's when Tether really grew to be enormous, when the default collateral on BitMEX, BitMEX originally was collateral in Bitcoin, but then on Binance, they really started to popularize USDT margined perpetual swaps, right? And that is what really caused the Tether to become really dominant. Well, Tether was always dominant, but that's what ensconced their dominance. And then you add to that all the other venues that have spot trading against Tether. That has always been the first big use case for crypto. Now, the second use case for crypto has been capital flight. Capital flight meaning you're in China, you're in Venezuela, you're in Turkey, you're in Iran, you're in somewhere where you really don't want to hold the local currency. You want to get out of the local currency and get into something more stable. That's the dollar. It's the dollar globally. So those people moving their assets into dollars, that started many, many years ago. And it's a large amount of capital that wants to find its way into dollars, but those dollars are not circulating. Right? Those are not people trading in and out, going and YOLOing into perps or buying meme coins or whatever. Those are just people holding dollars in order to get dollar exposure. Okay? That was probably the second use case. The third use case has now been international payments. And it's largely international. It's not really domestic. There's a little bit of stuff like, oh, people in Venezuela are paying each other with Tether, they're buying groceries or whatever. But in absolute terms, because those are really backwards countries that have very high bouts of inflation, there's not a lot of money that you need in order to satisfy those use cases, right? It's by percentage, it's not a lot of the overall demand. So the much bigger thing is international payments. That really started to take off with the Russia sanctions. Russia and China started paying each other very significantly in Tether. starting in 2022, 2023. But then it really started to take off last year. 2024 is when we started to see international finance, international payments, import-export businesses, commodities businesses, things like what Zebu is doing and with respect to telcos paying each other. That kind of stuff really started taking off last year. And now it's reached a fever pitch with the passage of the Genius Act and the normalization of stablecoin payments. But it's still not normal people in the normal economy, right? That's a long ways away. And to be clear, it might never happen that way.
Okay. So do you see this gap between permissionless innovation and regulation being the barrier, or is it something different?
I think permissionless innovation, so it's worth defining. What does that mean? It's kind of a buzzword at this point, but permissionless innovation means that a technology is default yes instead of default no. Okay? Default no means you want to build a fintech product? Okay, you need to write up a business plan. You need to apply to the CFTC. You need to get a license. You need to get a license in every single state. You need to get all these people to say yes to what you're doing, and then you can launch your product. Okay, that is a default no in a regulatory environment. Okay, default yes is like the internet. The internet is default yes. If you want to create a website, you don't have to ask anyone. Just go create a website. Who cares? Whatever. You want to create a website to start a business about selling ponies online? Great. No one's going to ever ask you a question. Just go do it. Right? That is default yes. What stablecoins do is they turn finance and fintech into default yes instead of default no. It means that you don't have to ask anyone, you don't have to talk to anyone, you just go put up a website, create a smart contracts, hire some developers, and just go do it. And if it's good enough, then maybe you want to go and get regulated and go try to apply for licenses and blah, blah, blah. But as long as you're purely operating in stablecoin land, then you can just go do it. That is the power of permissionless innovation. It's the reason why the internet has become such a wellspring of innovation and startups and entrepreneurs, is because it's default yes. And crypto does that same thing to finance that historically has never operated that way. So that creates some downsides. It's part of the reasons why so many regulators are so skittish about stablecoins, is they're like, yeah, okay, default yes sounds good, but it does mean there's going to be blowups, which there have been. There's going to be scams, which there have been. There's going to be bad actors, which there have been. All of that is part of the soup that you decide to drink when you decide to make something permissionless in this way. But with the internet, turns out there's a lot of crappy stuff on the internet, but there's also a lot of great stuff on the internet. The same thing is true for crypto and stablecoins, which is why I think the US has been ahead of the game in recognizing the virtue of that, whereas a lot of the other countries that are more risk averse have been slower to embrace it.
So, let's zoom out for a little bit. I think for the everyday user, they look at a stable coin just as a dollar. Something that at some point they might be able to use, but at the same time, the new zeitgeist is all these digital asset treasuries. So all of a sudden you're seeing all these institutions, I think the last few months alone, $40 billion have been raised into all these DATs, and they now become the avenue for retail users to access underlying, stable tokens or crypto. How do you see that playing out in terms of the adoption or kind of the derailment of retail actually benefiting from stablecoins?
So DATs themselves, in a way, DATs are a kind of structural arbitrage, is the way I would describe a DAT. Right? So a DAT, very simply, is a company that you put it's a bucket that you put a bunch of crypto into and then you take it public. Right? That's what a DAT is. And that's why would someone do that? Is a question worth asking. The one answer, the OG answer for MicroStrategy is that, well, you can issue debt and take leverage to go buy more and more of the underlying asset. And that's kind of the original reason why DATs were created, or MicroStrategy was created, was to go do this in the corporate form. The reason why DATs fundamentally make sense is when there's a regulatory runaround, meaning that it's not possible to create a more efficient version to create a publicly accessible vehicle that retail can invest in. So normally what you'd want is just an ETF. If you can just have an ETF on the underlying, then great. That's a very tax efficient, very simple, low fee vehicle that you on the public markets can invest in this asset without having to worry about custody, right? Same reason why you invest into a bond ETF or a gold ETF. You don't want to actually own gold because that's a pain in the ass. But if you can own a gold ETF, great. It's a very liquid, easy to manage version of the underlying, right? Doing this for crypto makes perfect sense. Now for stablecoins, doesn't make any sense. I don't know why somebody would want to put stablecoins in a DAT. I don't think I've ever seen that. That would be bizarre. But there have been the underlying governance token for a stablecoin. So Ethena, we're investors in Ethena. We led their seed round. Ethena has a DAT that is called Stablecoin X that invests into ENA and may also have some USDE, which is the underlying stablecoin, as like a cash management position thing. But really the reason why you're doing it is because of getting access to ENA, the governance token, which is of course the more volatile asset that has a lot of upside potential. So that makes perfect sense, and it's, as a public markets vehicle, gives public markets investors access to invest in an asset they couldn't otherwise easily get access to. But ultimately it's mostly an access story rather than this is a fundamental innovation and this is going to persist for decades. Probably not going to happen.
So if we fast forward 5 years, a decade, who wins? Is it USDC? Is it Tether? Is it going to be Ethena? Is it somebody new? Is there going to be new tech that comes into the stablecoin marketplace? If you put your future hat on, what are you thinking is going to happen?
Yeah. So if you had asked me this 5 years ago, I would have guessed, 5 years ago is basically when USDC was created. Or I guess it was six years ago. If you had asked me then, I would have assumed that there's going to be one stablecoin for each currency. There's going to be a US dollar stablecoin, a yen stablecoin, a euro stablecoin, and that's not what we see, right? It's been many years now, and we see that there's a shitload of US dollar stablecoins, and there's like, one or two of any of these other currencies, if not zero. That's surprising. I was not expecting that. And so one thing that's very clear, stablecoins have massive network effects, right? It's like, why would you have two different assets that both have the exact same price and have the exact same features, right? They're both trying to be a dollar all the time. That's it. So why would you choose one over the other? Well, we now have an answer to that. Why do you choose Circle over Tether? The answer depends on where you are, what you're doing, right? If you're in DeFi, you really want to hold USDC because USDC basically has a monopoly in DeFi. It is by far the most used stablecoin on-chain in protocols, right? Now, if you're trading on Binance or OKX, then you want to hold Tether. USDC has very little liquidity on Binance relative to USDT. So what we've seen is this sort of cleavage of different parts of the market that are almost like sub-markets, right? So it's a little bit like, you might think that there really should only be one rideshare company. There should just be Uber. Why is there more than one? And the answer is like, well, actually, Lyft or Kakao Tea, which I guess the Kakao taxi market, like they're dominant in different markets. So maybe in principle it would make sense for there to be just one, but in practice there are all these local markets that have their own network effects within those markets, and as a result, there's not just one, and it looks like there's not going to be just one. There's going to be multiple players, and we're learning more and more what are those cleavages in the market. So one of those cleavages very obviously is on-chain. There will be one winner most likely on-chain, and it's hard for there to be two winners on-chain. It's hard for there to be like, well, USDC is big on Ethereum, but like this other guy is big on, Base, right? Well, Base, obviously, Coinbase, that's not gonna happen. But I don't know, say some, Optimism or whatever has its own stablecoin. Doesn't really make sense because it's too easy to bridge, right? The liquidity is gonna be shared and it's gonna move back and forth from each chain. That's why it's true, even on Solana. Even though Solana wanted PayPal USD to be the dominant stablecoin, USDC is still dominant because so much capital moves back and forth between Ethereum and Solana. So the yields migrate instantaneously from Ethereum to Solana because it's all one market, it's all conjoined because it's all on-chain. So when you have these cleavages that don't allow the markets to interoperate, right? Like Binance and on-chain don't really interoperate so much. Yeah. So the yields on Binance are just very different from the yields on-chain. So I think what you should see is that at equilibrium, if you're an exchange, you can potentially have your own stablecoin, right? So Binance had BUSD back in the day. They could actually do it. Hyperliquid can do it with USDH. So that's one. If you have captive capital and demand that doesn't interoperate that much, you can have your own stablecoin. On-chain is going to have its own stablecoin. Emerging markets, they may potentially have their own stablecoins if they are separated enough from the rest of the world. Could be that Venezuela has a different stablecoin that everybody else uses. Then you've got payments between companies. plausible that you can have intercompany payments use a different stablecoin. Maybe they'll use JP Morgan coin. Maybe they'll use something else. Who knows? But intercompany payments, clearly, companies are not using DeFi. Companies are not using Binance. But they are paying each other, and they are potentially in their own network relative to everybody else. So the more that you see these networks be disconnected, the more likely it is that at equilibrium, they can have their own stablecoins. But within that network, likely there's going to be just one dominant player for each of those sub-networks in the stablecoin space.
Thank you so much for your insight. I think it was very educational, and obviously wishing you all the success. And thank you, guys.
Thanks so much. Thanks, everybody.